Let's lock in. We're about to break down how 5 stocks could benefit when the Federal Reserve finally cuts interest rates. I'm going to talk to you the same way I talk to my own community inside M.B.U. Direct, clear, and disciplined. Now, before we even touch the companies, let's set the stage. Interest rates are the price of money. When that price is high, everything slows. Mortgages get more expensive, car loans climb, companies borrow less, and growth stalls. When the Fed cuts rates, the whole system feels relief. Borrowing gets easier, buyers step back into the market, and businesses start breathing again. That's where our 5 companies sit, right in the middle of this story. D.R. Horton, Realty Income, Rocket Companies, Zillow, and Carvana. And we're not here to chase green candles. We're here to prepare. We're here to buy into pullbacks at the zones you already marked on your charts. We're here to dollar cost average slow and steady. Remember, you are the CEO of your own portfolio. CEOs don't make emotional trades. CEOs execute plans. Ticker DHI. D.R. Horton is America's largest home builder. They build everything from starter homes to move-up homes. And when mortgage rates drop, demand snaps back. Couples who were told no on a mortgage because their debt-to-income ratio, ticker O. They call this one the monthly dividend company for a reason. Realty Income is a REIT, a real estate investment trust, and its power is simple. It owns property, it collects rent, and it pays you monthly. That steady drip of income is what makes O attractive, especially when interest rates start falling. Here's why. When the Fed cuts, the cost of borrowing for Realty Income drops. They can refinance debt cheaper, they can expand more easily, and suddenly their dividend yield looks way better compared to treasury bonds. Investors sitting on government paper at 4% start saying, wait, I can get the same or better with O plus upside. That rotation of money alone can lift REITs across the board. But don't ignore the risks. If the Fed cuts because the economy is slowing too hard, then the focus shifts to tenants. Can they keep paying rent? Will retail stores, industrial companies, and experiential tenants hold strong? Rent checks only clear if the businesses underneath them survive. That's where you keep your eyes on coverage ratios and occupancy rates. For your plan, stick to the zones. The first support level is your starter slice, a way to begin collecting that dividend while you wait. The second zone is where yield on cost becomes more attractive, where patience pays. The third zone? That's your bargain territory, when fear is loud but the cash flow is still steady. Don't overthink it. Wait for your levels and buy slow. Rocket Companies. Ticker RKT. Rocket is built for one thing: volume. Mortgages, refinancing, originations. When rates are high, the phones stop ringing. When rates drop, the floodgates open. People rush to refinance. Buyers who were locked out now qualify. And Rocket has the brand power and the technology to handle that. Zillow is the front door of real estate. Millions of people start their home search there, even if they're just daydreaming. When interest rates fall, that window shopping turns into real shopping. Agents spend more on ads, sellers list more houses, and buyers browse more listings. Zillow feeds off that volume. More clicks, more traffic, more ad dollars. And with their mortgage and rental services layered in, they can earn from multiple angles as activity rises. But let's not pretend it's bulletproof. Zillow depends on confidence. If the Fed cuts because the economy is sliding, agents might hold back on marketing spend, buyers might hesitate, and sellers might stay frozen. And investors still remember the iBuying failure, which hangs in the background. That's why your zones matter more than hype. Don't chase Zillow when the chart is stretched. Let it drift back to your first zone for a starter position. Add more at your second. If it drops to your third, that's when patience pays off. Carvana, ticker CVNA. Carvana is like strapping yourself into a race car. When credit gets cheaper, auto loans open up, affordability improves, and buyers who couldn't qualify before suddenly can. Add in the fact that Carvana has been fixing its balance sheet, cutting costs, and focusing on profitability, and you have the recipe for a big run when demand comes back. The upside is explosive. High short interest, high volatility, and a business that breathes easier when borrowing costs fall. That's why it can rip. But risk is just as real. Carvana is still loaded with debt. If the job market softens, demand can cool off quick, even if loans get cheaper. And this stock can humble anyone who forgets that volatility cuts both ways. That's why your zones are your seatbelt. First zone, small starter. Second zone, steady add. Third zone, only if the market gives you that buying deep stock is only half the story. The real power is in the plan. That's where your dollar cost averaging framework comes in. Zones are the anchor. You've already marked them on your charts, and those levels are your battlefield. First zone, nibble, start small, let the market prove itself. Second zone, add with confidence if price pulls back further. Third zone, that's your deep value. If fear drags the stock there, that's when you pick up more size. This structure protects you in both directions. If the stock rips higher and never comes back, you at least have a position. If it dips deeper, you're not stuck at the top. You're layering in like a pro. And trimming is just as important as entry. Think about it like a ladder. Take some profit at 25%, take another slice at 45%, take more at 70%. By the time you've harvested along the way, you've already paid yourself and lowered risk while still keeping core shares to run. That's how you move with peace. Let me stop here and remind you, this is not financial advice. If you go all in on one of these names at the very top and then panic when it drops, nobody can fix that but you. You are the CEO of your own portfolio. The board meeting happens in your mirror, not in the comment section. The 5 companies we covered each sit right in the middle of what happens when rates fall. D.R. Horton builds the homes people need. Realty Income collects rent and pays monthly. Rocket rides the mortgage wave. Zillow monetizes the housing marketplace. Carvana financing sensitive auto sales. Every single one of them benefits when money gets cheaper, but none of them are guaranteed. That's why discipline matters more than hype. Quick pause here. Hit like and subscribe if you haven't already. It's not just about me, it's about the algorithm. When you engage, this kind of structured education rises to the top and more people find it instead of gambling in the dark. That one click from you might be the reason someone else finally learns to slow down and plan. One last time for the record, this is not financial advice. Don't gamble your rent. Don't risk money you can't lose. Treat this market like the battlefield it is. Move with discipline, move with structure, move with patience. That's what a CEO does. And now, the final call. Join us inside M.B.U, Moneybag University. That's where we live this every single day. Levels, coaching, accountability, family. We are building wealth little by little, stacking wins. About the ETF that eats fear for breakfast. This is the ProShares Ultra Pro Short QQQ. It's a 3x leveraged inverse ETF that runs the opposite of the NASDAQ QQQ. When tech stocks crash, SQQ spikes, and that makes it a powerful tool when you know how to use it. Now, here's where it gets strategic. You can play this 2 ways. 1, shares, just buy and hold, short term. It's affordable and easy to scale into. 2, options, calls or puts. That's where the juice comes in. With options, you can catch 30, 50%, even 100% returns, but you gotta time it right. This isn't about gambling. It's about waiting for the market to break and then pouncing with a plan. At M.B.U, we don't chase, we trap it. Benefits of SQQ. Leverage. You get 3x the inverse move of the NASDAQ. Hedges your bullish portfolio. Great for downtrends, market panic, or major red days. Cheap to enter, easy to scale. But there's a catch. Cons of SQQ? Decay. This thing bleeds slowly over time. Holding long term, you're toast. Only works when QQQ is falling. Choppy markets will burn your position. That's why we train to be snipers, not cowboys. We wait, we watch, we confirm, then we strike. How to trade it the M.B.U way. Use a 5-minute chart for confirmation. 3 strong red candles equals you're in. Don't dump your whole account in. DCA, dollar cost average, your entry. Start with 1 contract or 10 shares. Wait for a deeper move. Add again only if the setup confirms, not because of emotion. Set sell targets, 25 cents, 45%, 70%. Never hold past your plan. We play it smart. No FOMO, just discipline. At M.B.U, we use FQQ to catch moves when the market panics, train students on risk management, build confidence in high volatility trades. This is not some guesswork. This is structured execution. We don't fear red days. We profit from them. Join the team. Learn how to run shares and options with confidence. Trap the market.
Big opportunities in life have to be seized. We don't do very many things, but when we get the chance to do something that's right and big, we've got to do it. And even to do it in a small scale is just as big a mistake almost as not doing it at all. I mean, you've really got to grab them when they come, because you're not going to get 500 great opportunities. You would be better off if when you got out of school here, you got a punch card with 20 punches on it. And every financial decision you made, you used up a punch. You'd get very rich because you'd think through very hard each one. I mean, you went to a cocktail party and somebody talked about a company you didn't even understand what they did or couldn't pronounce the name, but they made some money last week and another one like it. You wouldn't buy it if you only had 20 punches on that card. There's a temptation to dabble, particularly during bull markets. In stocks, it's so easy. It's easier now than ever because you can do it online. Just you click it in and maybe it goes up a point and you get excited about that and you buy another one the next day and so on. You can't make any money over time doing that. But if you had a punch card with only 20 punches, you weren't going to get another one in the rest of your life, you would think a long time before every investment decision. And you would make good ones and you'd make big ones. And you probably wouldn't even use all 20 punches in your lifetime, but you wouldn't need to. Yep.
Entertainment purposes only. It does not constitute financial advice. All investments involve risk. Do your own research. Manu Banner is not a licensed financial advisor. The M.B.U. Group is also not responsible for any financial decisions you make. Any third-party content used falls under fair use for commentary and analysis. Please consult with a licensed financial advisor or professional in your area before making any investment decisions.